Hello everyone, Andrew here with a new YouTube video. In this one, I'm going to talk about trade management and how you can use partials to break even a trade, how to manage a trade, and how to actually increase your profit expectancy. First of all, I want to talk about using partials to break even. This is a concept that not a lot of traders know and use. I'm personally not really using it, but it is a good way to actually go break even on a trade without pushing your stop loss at break even. So let me explain. Partials allow you to remove risk without actually choking the trade. So for us, because we are trading the smaller time frames and we usually have really small stop losses, the trade usually tends to go back to our break even point, to our entry point, and take us out of the trade at break even before going to our take profit. To better explain this, let's say we enter a short here and price goes into our profit for a 1-to-1 or a 1-to-2, and then what usually happens, if this is our entry point, price can return to mitigate the area, maybe give a small reaction, then come back, range a little bit before having the huge move. So if we put our stop loss at break even here, then usually we get stopped out and then the price goes into our direction. So in order to avoid that, we can use partials so you don't have to actually put a stop loss at break even. So let's say, for example, we take 20% partials to cover risk at a 1-to-4 or 4-to-1 risk reward. So if we are risking, let's say $1,000, we are risking 1K on a trade. If our trade goes to 4%, so let's say again we enter here, price goes to a 1-to-4 right here, 4%, so that is for us $4,000 in profit. Instead of going break even here on the trade, what we do instead is we take 20% off from the trade. So what that means is that if we have $4,000 running profit, if we take 20%, that means we are taking $800 as profit. So we're closing $800 from the $4,000 profit. And then what we do, because let's say we have 10 lots, right? We have 10 lots running. So our stop loss is 10 pips, and then we are going for, or actually let's use a bigger lot. Let's say we are using 50 lots, right? 50 lots with a 2 pip stop loss. So that is $1,000 risk. If our trade goes to 8 pips, that's 4,000. So from those 50 lots, we close 20%, which is 10 lots. So we close 10 lots in profit, and that is $800. So we are left with 40 lots. Now, our initial stop loss of 2 pips now becomes from $1,000 to $800. But we also took 10 lots profit, which is $800. So now what that means is that our risk, if our stop loss is here, turned from $1,000 to $800, but we also closed $800 in profit. So if our trade goes back to stop loss, then we basically go break even because we closed $800 in profit, and then we lose $800 if our trade goes to stop loss. What that does for us is it allows us to keep our stop loss in place and not go break even in case the trade wants to go back, retest, and then go on. So if that happens, first of all, we removed our risk from the trade, so we can have the initial stop loss, and if the trade goes on, then that's perfect. If trade does decide to go back to stop loss, then we are break even on the trade. But that allows us to stay in the trade longer, especially if you are losing smaller stop losses, then you can have a 1-to-4, 1-to-3 almost instantly. So you can remove the risk from the trade, and then basically you can let the market do whatever it wants. Also, small stop losses can equal high commission. So that means that you can partial more volume. So let's say, for example, 25% at 4R, just to cover commissions as well. Because if you are opening 50 lots, on a standard broker, that's $7 a lot, that's $350 in commission. So if you're closing 10 lots, then you're kind of gonna need to close more, because with commissions, that's gonna be a lot more. So you're gonna end up in negative if you only close 20%. So I hope that's really clear. This is a good strategy to manage your trade, especially if you're trading the smaller time frames with small stop losses, 1-2 pips, high lots. You can remove the risk almost instantly, because if you are entering into a POI, then you most likely will have an instant reaction. You can take risk off, and then price can come back, mitigate, but your stop loss is still in place, and then the trade plays according to your plan, and then you can stay in the trade longer. So now trade management refers to everything a trader actively does after a trade is executed to minimize risk and maximize potential profit. That is why we talked about that strategy of closing partials at the 1-to-4, because you can maximize the potential profit because you remove the risk of getting hit at break even and your trade going your way. So depending on your win rate and your average risk reward, then you can have a profit expectancy. So what that means is if you're having a 30% win rate, but you're having an average risk reward of 1-to-5, then you are profitable. If you have a win rate of 70%, and a win rate of and an average risk reward of 1 to 2, again you are profitable. So you need to have a balance between your win rate and your average risk reward and just stick to those in order to become profitable over the long run. A lot of traders, again, they do not respect these two things. They start taking profits earlier, they want to see the trade run for more, their win rate just plays around, and then they cannot be profitable on the long term because they are not sticking to their rules. The most important one is have the same trade management rules for every trade you take, the same risk reward. So for example, for me, on a counter trend trade, I always take partials at the 1 to 5. I always cut 80% because I backtested it and I saw that this is the most profitable way for me, because most of those trades just come back to hit me a break even. So if I take profits, then I can let the rest 20% run in case there is a big reversal coming. If not, then I secure my partials and I can go on with the next trade. There are 3 main tools to manage a trade. So we have 3 examples right here. We have the take profit order, where we just take full take profit. The pros of it are, it's just set and forget because you don't need to manage the trade, and then you're gonna have the full size on your lot size on large winners. So if you want to take profit at a 1 to 5 all the time and you just let the full size of the trade run, then again you're gonna have a lot more profit because you are letting the whole trade run without taking partials. But there's the risk that you can give running profit back, so price can go on towards your full take profit and then reverse and hit you at break even, and instead of taking partials you basically lose all the running profit. I don't really enjoy this, so I'm gonna show you which one I use later. And also, risk is not covered unless trail. So if trade goes into profit and you don't go break even or just set your stop loss in profit, then there's a risk of it reversing and taking you out after being in profit. So this strategy is better. This trade management strategy is better when you are using small risk rewards, let's say 1 to 1, 1 to 2, 1 to 3, and you also have a good win rate so you can be profitable on the long term. The second tool is taking partials. So again, this is set and forget because you can use a tool like Trade Manager on MT5 or MT4 to set take partials. So you can take the partials out of the trade automatically. You don't have to do anything. You're also gonna pay yourself because you're taking profits along the way. This is the most important. As a trader, you always need to pay yourself because that is why we are actually trading. And you're also covering your risk because you're taking partials. You're taking money off the trade. So if the trade goes back to break even, or even if you keep your initial stop loss like we discussed earlier, you're still gonna make profit. The cons are that you're gonna have a less size on winners. So you're not gonna have the full volume. If the trade goes to the final take profit, you're gonna have basically smaller profits on the way, and then the rest of the trade at full take profit. For me personally, I enjoy this strategy more because I like to pay myself, especially if you're trading a funded account and you're trading a bigger account. Taking partials and paying yourself on the way is the best thing you can do. Instead of going for the full take profit, the full trade, the big trade, you're paying yourself on the smaller, on every trade you take, and then it just compounds on the account and you're gonna get paid every single day if you're taking trades daily. The last thing that I don't really recommend is having a trailing stop loss. I don't recommend this one because you can be stopped on liquidity grab. So let's say trade goes up right there, and then you can have a huge drop to mitigate an area here, right? It takes you out from the trade, and then trade goes on even higher. This is what happens usually, and you got stopped out in profits, and then the trade went on to hit the full take profit. And you also need to manage it actively, so you need to move your stop loss in profit every single move. Every time a high has been made, you need to move your stop loss, and I don't really recommend it because again, you don't know if price wants to return to take liquidity and then go higher, especially in today's market. That happens a lot. The good thing is that you have risk covered with full size left, so you don't need to take partials, you just cover it. So if you get stopped out, then that's perfectly fine. And you can also exit on expectation order flow failure. So what that means is, let's say price is moving up, you have your stop loss in profit here, then price makes a change of character bearish, and then the expectational order flow is that price will continue bearish, and then you get stopped out in profit, and then the trade goes down more, so it goes against you. Again, just think about all these 3 management tools and pick the one that's perfect for your trading plan and the way you trade. For me, again, as I said, partials are the best way, especially on funded accounts. This is another important topic about targets, where to set take profit orders or partials. Again, this is up to your trading plan. You can either have a fixed R, so a fixed risk reward. It's just a numbers game. So if you always have a 1 to 3 target or a 1 to 5, you always go full take profit on that. And it's just a number game because you don't know if the trade is gonna hit your take profit or not. I don't really recommend this. What I recommend is you use technical targets where price is going to pull back or reverse, and that means you're gonna pick your targets from supply and demand zones or structure liquidity. So if price you're going to buy here, you just target the next supply zone where you think price is going to reverse and you just take profits there. This is what I recommend because structure and especially liquidity and supply demand are the most important zones where price can reverse and start going against. So that is where you should actually take profits. If you are having a pro M15 trend, then I recommend taking 20% volume at 4 hour and then just let the 80% volume run until the next 15-minute swing, high or low. So if you are having you had a big move and then price starts pulling back and then it realigns bullish and you go along here, then you can just remove your risk. You take 20% at 4 hour, let's say here, and then you just aim for the high here because it usually goes higher than that, so you can take full profit there and you can maximize the profit on your trade. This is an example of a trade management rule having a fixed R and technical targets. So let's say for here price is going up, right? Let's say you get into a buy here, you just target a fixed. If you are entering on the counter trend, so if price starts to pull back, you have the change of character, you have the entry model here, you enter here again because it is counter trend, then you should take profits at the next 15-minute low, which is this one. So let's say you enter here, you have a smaller stop loss, you take profit at a 1 to 5 or 1 to 4, and then you let the rest run here, or you just go for the bigger zone, which is the 4-hour zone right here. The next example, you can go take a buy here. So if price realigns bullish right here, goes bullish, you can take a trade, for example, here after you get a pullback, and again you can aim for a 1 to 4, take 20% off, remove your risk, and then aim for this right here for the full take profit. I hope this video helped you because taking entries is not the most important thing in trading. Also, trade management is important because you need to know when to pull profits, how to manage your trade, and how to increase your profit from a specific trade. So if this video helped you, then go ahead and like the video, subscribe, and leave a comment down below, and don't forget to join the free Telegram group, and I'll see you guys in the next video.